And I think we can move on to the next session now, which is going to be on alternative investments. And this is going to be chaired by Mrs. Laura Merlini. Laura is managing director at the CAIA Association. She was formerly with Fortis Bank, and she's also serving as an executive director, non-executive director for a consulting firm, I believe. So, Laura, thank you very much for being with us today. And the floor is yours to chair your session and introduce your esteemed speakers. Thank you.
Absolutely. Thank you. Thank you. And good afternoon, everyone. And a special welcome, I would say, to all the CAIA members in the audience today. As you know, I'm Laura Merlini. I'm Managing Director for EMEA, the CAIA Association. But for those less familiar with us, CAIA is the professional body in alternative investments. But we are also the most energized community of investment professionals around the globe devoted to improve investment outcomes. So I would say that CAIA is like Professor George Schiadopoulos. We never, I would say, linger in all vision of the past, but we are always looking around the corner of what's new and what's next. And today, and that's the goal of today, we'll explore new patterns in commodity markets, and also we'll have fresh perspectives on private equity allocation. And we have an exceptional lineup to guide us. And let me introduce our first speaker, Professor Alberto Rossi, the Aishigian Family Professor of Finance at Georgetown University's McDonough School of Business. Alberto wears many hats. He's the director of Georgetown's AI Analytics and Future of Work Initiative, a visiting fellow of Brookings, and serves on FINRA's Economic Advisory Committee. So his research sits at the fascinating intersection of fintech, machine learning, and asset pricing. And today, Alberto will present on short-term basis reversal in commodity markets. And he has uncovered a novel return anomaly. So what makes this exciting, we will find in a second. Thank you, Alberto.
Thank you very much, Laura, for the great introduction. Let me share my slides first. Can you see my slides?
Yes.
Put them full screen. Perfect. Okay, so thank you for the very kind introduction. This is a joint work with Constance Zhang and Yanji Zhu from Peking University and CUFE. And the starting point of our work is really trying to address one of the fundamental questions in finance, right? So for the longest time, a huge amount of the literature is trying to understand how new information is incorporated into asset prices. And over the years, we have this massive literature that have evolved into studying momentum, for example, short-term and long-term reversals. These have been widely documented. Why are they helpful from an academic perspective? Well, because they really can help us understand market efficiency, how investors incorporate new information, whether they underreact to news, whether they overreact to news. And of course, also from a asset management perspective, they've been contributing a lot to quant investment strategies for years. Now, one thing that we realize is that much less is known about the predictability across the term structure of asset pricing. And if you think about it, this is very important because you have that a lot of financial instruments are characterized by a term structure. So you have that commodities have term structures, stocks in the futures, corporate bonds will have all term structures. And all futures at different horizons have different interpretations. For example, we know that the prices of futures at different maturities can be taken as proxies as market participants' expectations. But even in the context of commodities or exchange rate, a lot of the work that we've seen is studies that have been trying to focus on documenting, for example, carry strategies, momentum strategies, but focusing always at specific horizons. And in every time you think about futures returns, you can really think about decomposing the risk premium of the expected return that they deliver into spot premium, which is what you should expect to be the expected returns for given expirations, but also term premium, which is how much return you can harvest by investing across the futures curve. So a lot of the determinants of term premia have been much less understood, and this is what we're going to be doing in this paper. We're going to try to focus a lot on this. And now, just to give you a very brief intuition, the way I would like you to think about it is that the main difference between our work and the existing literature is that the existing literature operates or tries to work in following the graph on the left, where you have that, for example, in the context of momentum, what I want to do is to know what is going to be the expected return on the assets, and I'm going to model it using the past returns of the same assets over the past 12 months, skipping the last month, or in terms of reversal, I'm going to try to understand the expected returns of a certain asset on the basis of the past returns. What we're going to be doing is something a little bit more complicated. Now, if you're thinking about futures, I'm going to have a futures curve. For example, this is going to be the futures curve at time t minus 1. This is going to be the futures curve at time t. This is going to be the futures curve at time t plus 1. So instead of trying to understand what is going to be the expected return, for example, of a certain future, given the past returns of this future, what we're going to do is try to understand what is going to be the expected return of the future that has longer expiration, given the behavior of the return of the future with shorter expiration. So we're going to do what we call this cross-horizon predictability. And the way we do it is rather simple. So we're going to focus, at least for the main results, on something very simple. We're going to start with 22 commodities. These are the standard commodities that are most traded. We get data from DataStream. We work with the last 40 years in terms of dates. And of course, we do all the typical cleaning that you should do in this kind of work. For example, we restrict analysis to futures contracts with at least 1 month to expiration. This is to avoid the usual erratic behavior of commodities around first notice days. And now I'm going to have one slide or two with a little bit of math, but it's going to be very limited. Effectively, what we're going to be computing is fully collateralized excess returns. So if I think about the return at time t for a future with nth and nearest to expiration future, I'm going to have that. I'm going to just do the ratio of the price of that future at time t divided by the one at time t minus 1, and I'm going to subtract the 1 as 1. So we're going to just computing the return for the first contract to expiration and the one to the second contract to expiration. That's going to be the focus we're going to be focusing on at the very beginning. And then we're going to focus on fully collateralized returns, but we're also going to focus on spreading returns, which effectively is just the return difference between the contract with that is expiring as soon as compared to the one that is expiring instead, the second contract to expiration. Now, in this paper, we're going to focus on 4 strategies and 4 signals. I hate to make it a little bit complicated, but I really need to. What we're going to be doing, like the simplest strategy we're going to do is we're going to forecast the return the following week on the future with longer maturity using the return of the future with shorter maturity this week. The second strategy is going to be exactly the same, but instead of using the return on the first contract, we're going to do the spread of the return of the first minus the second contract. And then the third and fourth strategy use exactly the same 2 signals, but instead of investing in the contract, in the second contract, they're going to just implementing spreading strategies where they go long in the second contract and short in the first contract. And just a few notes before we get into some of the results. Just unconditionally, you have the very few commodities would have given very high returns. The ones that deliver high performance have been gasoline and copper, for example, over our sample. You have that second year by contrast deliver slightly better unconditional performance. So they do perform slightly better. And you have that the longer maturity contract tend to have slightly lower volatility compared to shorter maturity contract. Now, let me show you the main results first. I know that this is a little bit busy, so I'm going to go a little bit slow. The first strategy I'm going to show you the results for are what we call cross-sectional strategy. And what we're going to be doing here is we're going to invest in the second contract. And in the first row here, we're going to sort the commodities, the 22 commodities, on the basis of the return of the first contract in the previous week. So if you do this, what you're going to have is that the lowest fourth commodity the following week will have negative return, the one in the middle will have slightly positive returns, and the one that instead have performed very well the previous week in the first contract will perform very well. So if you do a high minus low strategy, you're going to have a 12% return every year and a Sharpe ratio of 0.5. Now, if you don't use as a signal the return of the first contract, but you do the spreading return, so the return of the first contract minus the one of the second contract the previous week, you're going to see that the performance is much better, right? So you have around 18% in performance and a Sharpe ratio of approximately 1. Now, the question is whether this is something that is confined to maybe the late 90s, early 2000. Doesn't seem to be the case. You have that if I split the sample between pre-2000 and post-2000, you have that the performance and the Sharpe ratio, if anything, they actually tend to improve. Now, the second strategy that we have, as I mentioned before, doesn't invest in the second contract, but does the spreading strategy of the second minus the first. So in here, what you're going to have is that this is going to be a strategy that has much, much lower volatility. But the performance is very good in the sense that you have the same monotonic relation. The returns are not very high, just in terms of the absolute returns, but the Sharpe ratios are very high simply because you have that the volatility is very small. And if I do if I invest in the second minus first spreading returns using the previous week spreading returns, you're going to have even better performance. So this to say you're going to have, you can get even to a Sharpe ratio of 1.5. All this to say that there seems to be a very strong cross predictability in terms of the returns of the futures with different horizons. Now, you may be worried that some of this performance is just limited to a few episodes in history. This doesn't seem to be the case. What we show here is the performance of the forecasting the second nearby returns, either if I use the first contract or the spreading as a sorting variable. You see that the performance is systematically going up, and instead, on the other hand, you have that the average commodity returns have been relatively flat. And if I work with the spreading returns, I'm going to have pretty much the same. So you have that, you consistently have that this basis reversal strategy consistently outperform. Now, the question we ask ourselves is whether we are loading on some known commodity factors. For example, people have isolated carry, momentum, or basis momentum in the literature, and this doesn't seem to be the case. If we do simple spanning test, you have that the alpha of our strategies are pretty much identical to the expected, to the excess returns, the average returns what we document, so as to say that they don't load at all on the standard factors. And the last set of results I want to show you is the performance of this strategy, not in the cross-section, but in the time series. Now, instead of working and sorting commodities into buckets and investing in some and staying out of some others, what we can do is implement a time series momentum strategy. This is effectively trying to understand where the basis reversal exists for each commodity in the time series dimension. This trading rule is very, very simple. We're going to take a long position if the return of the first contract is positive in time t, and we're going to be investing in the commodity for the following week. And instead, we take a short position if the return is negative. And we do exactly the same if instead of using the return of the first commodity, the spreading return is positive or negative. What you'll see is that if we do the analysis across all the individual commodities, the Sharpe ratios are always positive. Of course, these are very, very under-diversified strategies. If we put them all together, once again, you have pretty high returns, pretty high Sharpe ratio. So you get a Sharpe ratio of 1 or 1.5. Now, in the last part of the paper, what we try to do is understand the economic drivers of our strategy. So we rule out that our strategies are driven by inventories. So we know that in many cases, inventories can affect a lot the expected returns of our futures. So we actually find that our reversal is existing both in backwardated and contango commodities. We show that this doesn't seem to be driven by the average hedging and spreading pressures of non-commercial traders. And you have that our favorite explanation is really that one of the limits to arbitrage and preferred habitat. In this, we say this because we find that the results are very strong in high volatility states. We find that the performance is particularly high when the second nearby returns, so the ones that are further away from expiration, are more autocorrelated, so where their prices are less update less efficiently. Where you have that there is a low cross correlation across maturity. And we also find that the performance of our strategy is particularly good when the first nearby contracts are further from expiration. Now, of course, this limits to arbitrage and preferred habitat interpretation of explanation is not specific to commodity markets. So if it's really correct, it should appear in other asset classes. So we repeat the analysis not only for commodities, but we do it for stocks into futures, for corporate bonds, for treasury yield curves. And we find that basis reversal is definitely a general feature across all this term structure. And of course, in the very back on the paper, we do a ton of robustness checks. It doesn't matter how many commodities we have in the extreme portfolios, our performance stays very strong. We find that the basis reversal is not only present between the first and the second contract, but extends at longer maturity of the futures curve, even though it's slightly less strong. We find that it's not driven by high volatility commodities. We can do everything with volatility scaling. And we can also include some decision delays. So some of the concerns you may have is that market microstructure noise may be driving some of the results. Of course, everything we do is weekly, so it's not that dependent on the price we trade at, but we also incorporate some decision delays, and the results hold across all the specifications. So to conclude, we find a new form of return predictability, which we term short-term basis reversal. We find that it's economically large. It's distinct from known factors. It really reflects a temporal inefficiency in information incorporation across the futures curve, and it seems to be general features of term structure markets. The implications for us as academics is that it really helps us understand how information flows and arbitrageurs trade across the futures curve. And I think we also is a valuable tool for asset managers in terms of generating alpha. But thank you so much for your time. I really appreciate it.
Thank you, Professor Rossi. We have a couple of questions that we will address during the Q&A. I would like now to introduce our second speaker. Today is the day of the Italian surname, so we have Kelly DePonte, Managing Director of Kelly DePonte Advisory LLC, a boutique private markets advisory providing strategic counsel to emerging managers. Mr. Kelly brings over 32 years of experience in private alternative fund investment and fundraising. That's more than 3 decades of watching this industry evolve. And today he will guide us through private equity and its place in institutional investors' portfolios. So we'll cover the landscape and dig into what really matters: returns expectations, liquidity management, and how manager selection drives performance. Kelly, over to you. Thanks.
Thanks very much. And just a quick correction, DePonte is Portuguese. Though I'm also a quarter Hawaiian. Though I'm also a quarter Hawaiian, which makes me very differentiated in this marketplace.
Excellent. Thank you.
Okay, want to be, excuse me, I'm going to be sharing a presentation. Okay. Basically, my firm is a boutique advisory and consulting firm. I have 30 years of experience in the marketplace, and I'm focused on currently on marketing, branding, and fundraising strategies, but have done a lot of due diligence work in the past as a consultant to people like CalPERS, State of Oregon, New York City pension plans, and also as a placement agent doing due diligence on which funds we actually feel were proper for placing, putting together a placement relationship. There are really key differences between private equity and publicly traded securities. Publicly traded securities are simple, usually simple in structure, and of course, valuations are readily available for them. But for private equity, the most common structure is a closed-end fund partnership with a 10-year maturity with commitments drawn down over a 5-year investment period. So very different from going out and purchasing a share of stock or various shares of stock. Also key here, though, there is a partnership structure. Limited partner investors have limited legal liability. And so any liability that arises really goes to the general partner or the fund manager.
Sorry to interrupt. We are not able to see the slides. Is there a way you could share them with us?
I thought I was sharing them. Hold on a second.
Thanks. Thank you, and apologies to interrupt. If you're unable to share them, oh, amazing. Thank you.
Great, thank you.
Thanks, thank you.
It's a wonder what clicking on the right button will do. Basically, again, if you're going back and looking at the differences, funds use active strategies with strong company board oversight and make changes to the company's strategy and operations in order to generate returns. And so it really is an active management strategy. And the other thing about that is if you're taking this active management strategy and making changes at the underlying company, it's a strategy that takes time to generate returns. It's not something that you make an investment and you can easily exit in 30 days. It very often takes 3, 4, 5 years to make significant changes in a company. Fund manager selection drives returns. Not all fund managers are adept in making these active investment decisions. In addition, because of that long-term value creation time, funds are illiquid. They're meant to be held for a long period of time, and portfolio values are usually only being revised on a quarterly basis. Now, there has been a secondary market that has developed in private equity, but that's totally negotiated. That's not like going on and buying and then selling a share of stock. There's a low correlation to the public markets, and on a long-term basis, diversified private equity portfolio net returns have been higher than publicly traded stock returns. That's net returns, net of fees. Private equity funds charge annual fund management fees of around 2% on committed capital and 20% on capital gains, the gains when they do exit, calculated as carried interest. Major private equity sectors. Private equity is extremely broad definition, but when you're digging down into it, there are various types of strategies that fund managers pursue. First of all, buyouts. Those are investments into well-established cash flowing companies, often purchased with substantial debt as well as equity. And there are subsectors there, large buyouts, buying some of the largest companies that exist. That market tends to be a very, very efficient one. And that's why there are a number of investors or fund managers who focus on middle market buyouts, an area where there are many company opportunities and more opportunities to make operational and strategic changes to generate returns. There's also a strategy called buy and builds, in which you buy a platform company in a certain industry and then grow it larger by making sometimes 3 or 4, sometimes as many as 10 acquisitions to build out the base company. And that is a strategy also, as well, as you're going through that acquisition and integration process. And proper integration in that strategy is key to making money. That actually strategy takes a little bit longer, more like 6 or 7 years rather than 4 or 5 years. Another category is growth capital. And those are investments into smaller companies that are growing quickly, or are late-stage VC-backed companies that have sort of gone beyond a true venture capital definition, and they need more capital for continuing expansion. Or increasingly in this market, they're led by founders, CEOs, and who control the company, who wish to hold on for a longer period of time and don't want to exit through an IPO or a sale. Venture capital, investing in new companies, often at the founding stage of a company, much more risk that's entailed. And the subsectors there are seed stage investing, really sort of founding an idea. Early stage, mid stage, late stage expansion are the various other sectors of the venture capital market. Turnarounds and distressed, targeting companies that are either stressed or distressed, sometimes buying them out of bankruptcy. Co-investments, those are investments outside of a fund, alongside the fund manager, made with a different pricing structure than a fund, often much lower pricing on those transactions. And then secondaries, vehicles focused on buying positions in current funds that are already invested. So instead of getting into a blind pool, you're basically able to take a look at a lot of the companies that you're going to be investing in through a secondary process. There are also allied areas to private equity. The allied alternative markets include private credit. There are closed-end funds investing in various types of debt, very often high yield, and these are buy and hold positions, not trading positions. There are subsectors of this. Mezzanine, which is a long-term sector, it's been in the private equity markets for 30 plus years, and it's often included in the private equity bucket because it usually includes equity warrants or options. Venture debt, often included in venture capital, it also includes equity warrants or options. The difference there, it's in investing debt into very, very young companies where there is more risk. And so the equity option warrants or options are much more an important factor of return there. You need to have some home runs to cover losses that you're probably going to have in pursuing the strategy. Real estate, that includes closed-end investment funds, direct investments in real estate, which a lot of public pensions do, for example. And then in some instances, REITs, real estate investment trusts. These are publicly listed and traded vehicles, and for that reason, sometimes these are included in public equity allocations as opposed to into a real estate allocations. Infrastructure, closed-end fund investing in infrastructure assets such as toll roads, airports, or ports. Real assets category is one which has a few significant subsectors, but it's also fairly small. Those subsectors include agriculture, metals and mining, heavy emphasis on the mining, and timber. But sometimes this is a larger asset class, which includes, for certain investors, real estate and infrastructure in that same real assets bucket. Going to take a quick look at the fund structure of a typical fund. If you take a look at the top box here, the ABC Management Company, usually a fund manager, a general partner, forms a management company which will manage a series of different funds. So the consistent entity that's owned and controlled by the GP is a management company. The fund here, for example, this is the ABC Management Company and the ABC Healthcare Buyout Fund number 2. You have here a number of limited partners who are investing their money into the fund structure, and they're paying profits out of the fund structure. There's usually also, for the largest investors, an LPAC, a limited partner advisory committee, which provides advice to the general partner. You have down here the companies that they're invested in, usually 10 or 15. Sometimes you have more concentrated portfolios. Sometimes, especially in the distressed sector, you have a lot more smaller positions as opposed to true control positions. You may have an outside sponsor who is invested in the management company in order to get a share of the profits that are being generated. There are often external law firms providing advice on fund formation and transactions. Fund administrators, this can be a complicated area where you've got investments in 10 or 12 different funds. Usually portfolio companies, and so having an outside administrator is key. And then also debt providers, sometimes to the fund, very often to the underlying companies. Then if you take a look at it, current institution allocations, the total market column includes everybody in the marketplace. And you can see that private equity is a 5% allocation. Private debt, because of those warrants and options on many of those vehicles, is often included in private equity. But you can see there's a higher allocation for pension plans, basically 10% total here, as opposed to 6% here for all of the entire market. Insurance companies have a higher allocation to private equity. If you're including the private debt structure, insurance companies are much more interested in the debt sector than they are in equity per se. That shows up in their allocation to public equities as well. And then in large endowments and foundations, you can see a very high allocation to private equity, and notably a lot of that would be composed of venture capital. They are much more heavily invested in venture capital. Market trends, private equity fundraising has grown tremendously over the past 15 years since the great financial crisis. The largest investors, both in currency amount and percentage of portfolio allocations, are pension plans, sovereign wealth funds, also insurance companies, endowments, and foundations. If you look at the increase, there's been a distinct increase over the past 15 years in private equity investment that was driven by current investors increasing their allocations, as well as newer investors coming into the marketplace. And this investment has totally upset the traditional 60% public equity, 40% private traded debt. And then high net worth and retail investors have become more important players in the marketplace over the past 3 or 4 years. But to just give you a graphic picture here, you can see this chart goes from 2000 up through 2024. You can see a very, very strong growth in the private equity market. The light blue line down here is buyouts. Then you have growth capital. Buyouts has been the largest sector for a long time, better understood by a lot of investors. Growth capital is a little bit more risky, somewhat of a higher return. Venture capital, a lot more risky, a lot more volatile. Fundraising is much more volatile because returns are volatile. So you have, basically sort of a collapse with the internet bubble bursting here. You have a decrease overall in private equity fundraising, but that's heavily driven by a surge in crypto investing, then a collapse in crypto investing in the venture capital side. On a geographic basis, the dark blue down below, basically North America is the largest market driven by the US, and it's the longest live market. The market really took off when regulations were changed in the US in the 1970s regarding pension plans. And Asia Pacific has grown somewhat, but the rest of the world investing is almost non-existent.
Kelly, we do have a few questions. So I don't know if you'd like to draw your conclusions now in the next 30 seconds, and then we go through the question.
Yes, sure.
Okay.
First of all, the key to risk management in this area, first of all, is fund selection and then fund formation. Fund selection, some managers do not have what it takes to actively manage underlying companies and their track records prove it. Second of all, limited partnership agreements I showed you before, they're not standardized, they're negotiated, and they often require the help of special external counsel. If you're a newer investor coming into this market as an institution, ways to do it is to invest through fund of funds, professional managed vehicles that provide reconnaissance for new investors. Secondary funds do the same thing with a little bit less risk because the investors are invested in mature companies. And there are also due diligence consultants that are available to help you. And that's basically it.
Excellent. Thank you so much. We have a few questions for you and for Alberto. I will start with you very quickly. What's the most important factors to onboard institutional investors into the PE funds independent from fees, performance, and settlement factors?
It really is due diligence. It is basically fund manager. Unlike where the public markets, manager selection drives returns. If you look at mutual funds, for example, there's roughly a 400 basis point differential between top quartile and bottom quartile managers. For buyouts, that's about 1,500 basis points. For venture capital, about 1,800 basis points. So picking the right managers is what the game's about.
Yes, exactly. And CAIA couldn't agree more. For Alberto, if you were to put in practice these predictors, would they predict that gold would had risen above $5,000 per ounce? And then Basis is well known to predict commodity returns. This is consistent with inventory theory for the determination of commodity prices. So what is the new in your presentation? Mm-hmm. There are also other well-known predictors like the net hedging pressure. What do we learn relative to this? Could you condense quickly?
Yeah, of course, absolutely. I think it's a very good point. So in terms of the gold, no, because what we are doing, our strategy is really something that will really take advantage of the weekly difference in or the weekly predictability in returns. Nothing have to do with the long-term predictability, of course. But what probably would have happened is that we would have loaded a lot on gold over time, just because. But we would have gotten in and out. Now, in terms of the other, that's actually a very good point. In terms of basis, is very different. So I have a paper on carry and momentum or basis and momentum in commodities. So basis is something that is horizon specific. So when I do a basis strategy, most of the time, I will focus on the specific horizon futures with specific horizons, and I'm going to implement, I'm going to sort my commodities on the basis of basis, and then I'm going to get in and out of these commodities. Now, this is different because what we're doing is we're computing the return on a commodity on a future with shorter expiration, and we're using it to predict the return on a future with longer expiration. So all this to say is that effectively what we're saying is that information is incorporated into the commodity that has a shorter maturity quicker, and it then it is reflected in the commodity with a longer maturity only later. You shouldn't expect that to be the case because you should expect arbitrageurs to take care of that, but they don't do it. They don't do it quickly enough. I mean, if you take our strategy and you go and you don't do this predictability at the weekly frequency, you go at the monthly frequency, it will be gone. So all this to say that this adjustment is something that takes place at a speed that is slower than you would expect, and that what generates our the profitability of our strategy.
Thank you, Alberto and Kelly, for sharing your expertise. And in alternative investment, we know that curiosity and rigorous thinking will always be your edge. So enjoy the rest of the conference, and back to Professor George.
Thank you, Laura, and many thanks to the two speakers, Kelly and Alberto. Thank you very much for being with us today and sharing your views on commodities and private equity.